Hi, I'm Suzy Rhoades with PassMasters. Welcome to this week's Questions of the Week. The topic for this week is characteristics of pooled investments. You can expect this topic to appear on the SIE exam, Series 6, Series 7, Series 65, and Series 66. We're going to practice some questions that are found within our PassMasters Securities courses. Let's check out what our learning management system looks like. Within our LMS, I have taken the Securities content outlines and broken them down into manageable topics. Each topic has a topic quiz. Each question within the topic quiz is written in a multiple choice format, just like your actual exam will be. Let's look at the first question. How long is a letter of intent good for? Choices include 9 months, 90 days, 13 weeks, or 13 months. A letter of intent is good for 13 months. So when you click on the answer, check answer, you will be given a choice to show the explanation. So each question in our course has a written explanation as well as an audio explanation. How long is a letter of intent good for? Monica purchased mutual fund shares today and also signed a letter of intent. The letter of intent is good for how long? Choices include 9 months, 13 months, 6 months, and 90 days. You know this one. It is 13 months, a letter of intent. The whole purpose of the letter of intent is to allow the client to get a reduced sales charge up front. So they're basically making a promise to purchase an additional amount of shares over the next 13 months. We'll give them the reduced sales charge right now. We're going to keep some shares in an escrow account just in case they default on their letter of intent to pay the additional sales charge. So letter of intent good for 13 months. Which of the following would qualify for breakpoints? Purchases made into the same mutual fund, even though made at different broker-dealers. I like that one. But let me urge caution, never pick the first right answer. Always be sure to read all 4 of your answer choices. Purchases made by 2 unrelated persons definitely would not qualify for a breakpoint. Purchases made into growth funds at different mutual fund companies, no. Purchases made into 2 different mutual fund companies, no. So the correct answer, purchases made into the same mutual fund, even though made at different broker-dealers. A breakpoint is a reduced sales charge. Which of the following is not taxable? Realized gain, unrealized gain, automatically reinvested dividends, automatically reinvested long-term capital gains distributions. So realized gain, taxable. Reinvested dividends, taxable. Reinvested capital gain distributions, also taxable. It's the unrealized gain that is not taxable. So paper profits only. So if you put $1,000 into the account and now the mutual fund is worth $3,000, but you haven't yet sold it, that's subject to market risk. Unrealized appreciation is not taxable. Which class of fund shares has the lowest 12B1 fee? We have Class B, AAA, A, and C. The lowest 12B1 fee is going to be found in a Class A share. But what in the heck is a 12B1 fee? So a 12B1 fee, sometimes called a trailer fee, 12B1 fee, is a fee that is a percentage of assets managed that the fund uses to reimburse itself for distribution expenses. A lot of times you will find a 12B1 fee in a fund that calls itself a no load. So they have no sales charge, but they might still have a 12B1 fee. So over the years, the industry evolved to have different classes of mutual fund shares. So I'm going to back up a little. When you purchase a pooled investment, so within the portfolio of the mutual fund, let's just say it's a balanced fund. Within the portfolio, you have some stocks and bonds in a balanced fund by definition, some stocks and some bonds. And when you purchase stock, when you purchase a pooled investment, what do you want the value of that investment to do? Go up, of course, right? You want to buy low and sell high. So you want the balloon to grow from appreciation. So if the balloon grows and you haven't sold the shares yet, that's an unrealized gain. It's not taxable until you realize the gain. When you have the mutual fund that has a sales charge, let me give you an example. So when we're purchasing open-end mutual fund shares, bid plus sales charge equals the ask. So for example, the ask is $10. The maximum sales charge allowed under FINRA rules is 8.5% of the ask. So that would be an 85-cent sales charge. The bid is $9.15. So when you buy the shares, you pay $10. So of the $10, 85 cents is the sales charge. $9.15 actually goes into the fund. The cheapest you could get this share would be if bid were to equal ask. If bid were to equal ask, that would mean that there is no sales charge. But it's important to remember that the sales charge does more than pay the commission to the person who sold the share. The sales charge also pays the distribution expenses associated with that share. So when a fund has no sales charge, oftentimes they will have a 12B1 fee. So a percentage of the assets in the portfolio that is charged as an operating expense. So let me show you how that works. Within this portfolio, stocks are going to pay dividends and the bonds are going to pay interest. And the dividends and interest make up what's called the fund's gross investment income. From the fund's gross investment income, we subtract out the fund's operating expenses. The operating expenses of the fund. So the largest expense of a managed fund would be the investment advisory fee, which is a percentage of assets managed. There's a custodian fee, a transfer agent fee. There's also potentially a 12B1 fee. So a 12B1 fee is an ongoing fee, a trailer fee, an operating expense of the fund that has the effect of reducing the fund's net investment income. And it's out of the net investment income down the pipeline through the conduit that the fund flows dividends to the shareholders. So if you look at this, if you pay a load, if you pay a sales charge, how many times do you pay the sales charge? Just once when you bought the share, if it's a front-loaded sales charge. How many times does the 12B1 fee affect your dividends? For the life of owning the share. So the 12B1 fee is different from the sales charge. Can the fund have a sales charge and a 12B1 fee? Yes. Can it be a no load and have a 12B1 fee? Yes. So over the years, the fund, same balanced fund here. Okay, we're not going to change the actual portfolio itself, but over time, there have been different classes of fund shares that the investor can choose to invest in. So for the test, the ones that I need you to know are Class A, Class B, and Class C mutual fund shares. Class A shares are front-loaded. So they would have this sales charge. front loaded. They have low to no 12B1 fees. They're going to have usually a breakpoint, schedule of breakpoints, so they're good for people that are putting in a lot of money all at once. A Class B share is going to be back-end loaded. Back-end loaded. It is going to have the highest 12B1 fee. So who is it good for the purposes of this test? It would be good for someone who's going to invest maybe through dollar cost averaging, $50 a month, plans on holding those shares for a very long time, because Class B shares will automatically convert to Class A shares after a period of time as described in the fund's prospectus. So Class A shares are good for people investing a lot of money all at once. Class B shares are good for people investing a little bit for a long time, long-term holding period. And then Class C shares are either front-loaded or back-end loaded, and they have the middle 12B1 fee. Middle 12B1 fee, and they never convert. So you have to know the three classes, A, B, and C. It is true a lot of funds don't even offer Class B shares anymore, but for the test, they do sometimes have questions on it. So just a little bit of review of how the pooled investment works and what the difference between a sales charge is and a 12B1 fee. Mutual fund shareholders may receive income in which of the following ways? Choices include interest, dividends and capital gains, dividends, or capital gains. So it is dividend income that flows through down the pipeline out of the fund's net investment income. So dividends for sure, and capital gains. That is the correct answer. Let me expand on that. So when we talked about the dividend income, so we had the dividend income coming out of the fund's gross investment income, subtract out the operating expenses, flows through to the shareholder in the form of dividends up to quarterly. It's also true, however, that the stocks and bonds within the portfolio, if they're sold for more than the cost basis, that creates a capital gain. So that the pooled investment, we'll say it's an open-end mutual fund, makes capital gain distributions. So anything that the portfolio held for a year and a day or longer distributes on a per share basis to the shareholders. A maximum long-term capital gain distribution, one time a year. So there's two ways that a pooled investment provides the investor with income. First is the dividend income. And second, it's a long-term capital gain distribution that's usually made in December. The maximum 12B1 fee allowed under FINRA rules is 0.75% of net assets, 0.25%, 0.5%, or there is no maximum. There is actually a maximum, it's 0.75% of net assets. I want to show you something though. This is a question a lot of students will miss, and I don't want that to happen to you. So this question asked about the maximum 12B1 fee, and it is 0.75% of net assets. Also written sometimes as 0.75% of net assets. And that is true. There's another question though that a lot of students are going to confuse with this question, and that is if the fund wants to call itself a no-load. I did say in that previous question that a no-load fund can still have a 12B1 fee. So if they want to call themselves a no-load, then the maximum 12B1 fee that is allowed is 1/4 of 1% of net assets. So different question, different answer, 0.25% of net assets. So just be careful that you read the question and give them the answer that the test is looking for. I know that seems really obvious, but it's really easy to just read the question too quickly and give them the wrong answer because you thought it said something else. All of the following are true regarding mutual fund withdrawal plans, except. Always reword the question without the except. What is false? The principal will last until the death of the investor starting the withdrawal plan? That sounds like an annuity, and withdrawal plans are not annuities. That sounds like a false statement. But let's make sure that the other three choices are true. And this is how I want you to approach your test. Don't just pick what you think is the right answer when you get to it. You have to check all four choices. So the other three should be true statements. The investor may outlive the withdrawal plan. True. Mutual funds require a minimum balance before allowing a withdrawal plan. True. Withdrawal plans are very different from annuities. True. So that means that that first choice, the one we thought was false, is in fact the correct answer. So with an annuity product, you cannot outlive the payments. Annuities pay you for life. With a withdrawal plan, you can choose a fixed share, you can choose a fixed amount, or you can choose a fixed period of time. There is a risk that you will outlive the payments. They can be self-liquidating plans, different from annuities. Mutual funds may make what kind of dividend distributions? Choices include realized, qualified and non-qualified, or long-term. Long-term is a capital gain distribution, so it's definitely not that. Realized? No. It's qualified and non-qualified. How do you know what amount of your dividend is qualified and what is non-qualified? You need to read your 1099. So as an investor, you don't keep track of that. The transfer agent sends you out your 1099 and it says on your 1099 how much your dividend distribution was qualified, which has preferential tax treatment. Currently, qualified dividends are taxed at long-term rates. If it's a non-qualified dividend distribution, those are currently taxable as ordinary income. So the dividend distribution from a mutual fund may be qualified or non-qualified. Maybe some of both. Very, very likely. It has to do with who is the issuer, so the dividend that was paid, who is the issuer, and how long were those shares held by the portfolio. You don't have to know all the details. You just have to know that qualified dividends are taxable at long-term rates currently, and non-qualified dividends are taxable as ordinary income. How often may a mutual fund pay capital gains? Choices include quarterly, semi-annually, monthly, or annually. Mutual funds may make capital gain distributions no more frequently than one time a year. So it is an annual distribution. Dividends can be paid up to quarterly. So that would be true whether or not we were talking about common stock or talking about a pooled investment. That concludes this week's questions of the week. We covered characteristics of pooled investments. If you have any questions related to this topic, just ask me in the comments below. If you would like to look over our course offerings or to enroll in one of our securities courses, just click the link that is found in the description below this video. Don't forget to like this video, subscribe to our channel, and turn your notifications on. I look forward to having you as a student soon. Happy studies! You got this.